please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
This is Bazaar Morning Call, live from the CNBC TV-18 headquarters in Mumbai.
Welcome to Morning Call. I'm Latha Venkatesh. With me, Anuj and Sonia. Well, I'm dressed in green because I think there is a bit of good news across Wall Street and maybe a little bit about Asia. Asia has not exactly followed on Wall Street's cues, but you know, our big worry is really crude. And with crude climbing a good 2.5% lower after that pipeline breach kind of rattled markets yesterday, today we should get some bit of succor, some bit of help and support from the lower crude prices. Just as a counter, the inflation numbers were not very good in India. But my own sense is that was already in the price. The yields going to 7.2 was a bit of a nasty premonition that inflation is not going to be maybe 4.3, maybe it'll be 4.5, 4.6. That was the buzz number. Nobody was prepared for 4.9. So there is still that bit of a shock which the markets will have to absorb today morning. But nevertheless, it's, to a large extent softened by the 2.5% fall in crude prices. So I would think today we start with positive cues.
Okay,
good morning, both of you.
Good morning. We will discuss, the macro data in greater detail. But let's also talk about the markets because yesterday we had a weak session. And Anuj, morning, the drop that we saw yesterday was led by a lot of heavyweights, HDFC Bank, TCS, etc. Do you reckon that could be the order of the day over the next few days as well?
Morning, Sonia. One thing which we have realized over the last 1 month at least is that you can't just look at the last 2 or 3 days and, make any move because, you will get butchered. Too many variables right now for the market to negotiate. The macro data, of course, Latha will talk about that. Crude oil, 2 days back, it looked like 65 was broken. Now it's even below 64. Advanced tax numbers are there. That's also going to be a bit of a pressure point for the market. Gujarat polls. So, I think we are right now going through a most volatile phase of current bull run where either you sit back as an investor and just buy the stocks when they come to your price, or you wait till, maybe this Monday is over. I'll just go through one, dot plot chart and see what's happened over the last 1 month, Sonia. In last 1 month, date to date, the Nifty is flat, okay? But it won't look like that if you see the chart. 10,225 to 10,118 to 10,400, 10,044, 10,320, 10,200, 1,200 point swing in a matter of a month. Who can trade that? Maybe Ashwani can, but it's not everyone's cup of tea. So it's been, of course, phenomenal in terms of volatility. I think the one key takeaway for me for last 2 days is that the Bank Nifty is showing some signs of a classical 20 DMA halt, though that also is not really, cast in stone. That could also turn because Bank Nifty really depends on HDFC Bank, and that has been sulking a bit for the market. So my sense is you stay nimble till Monday, and then there's a good chance that a decisive move happens Monday onwards on the market. And that's how, maybe individual stocks would do their jig, and that's where you
Monday
could trade.
Would be cathartic. I think it would be a binary event.
Yeah, exactly. Mini binary event for sure. Yeah.
Absolutely. And, speaking about this zigzag, actually, if you look at it from July 26th, the day we hit 10,000, and if you look at it today, we are 2.4% higher. But, it has given us so many highs. Exactly. It went all the way to 10,500 and looked like it would even swing higher. It has given us a lot of, crazy moments, delirious moments. But really, it's all of 2.4% over 6 months. So not much of a movement at an index level.
Well, then that gives us some time to discuss the macro issues because the big talking point really is what happened with inflation, right? I mean, 15-month high on inflation and vegetable inflation is now at what, a 4-year high?
22%, yes. But, I would point out, I don't know if you go vegetable shopping regularly, the price of tomatoes and onions has not become a generalized inflation. I can tell you 4 years ago, onions would rise to 40 rupees or 50 rupees and immediately everything would become expensive. You wouldn't get a single vegetable under 80 rupees. I mean, today you get even peas for 40 rupees, you get cauliflower for 40 rupees. These are usually expensive vegetables. So I would take heart from the fact that it is still only a tomatoes, onion inflation, and actually tomatoes have already halved. My last visit to the market, it was, down by about 20%. So I am not crazy crazily worried about the vegetable part of the inflation. Eggs also 8% higher, so that is also contributing, and that won't disappear in a hurry. The other part of the inflation which is higher is housing. Okay. Housing, LPG and kerosene have contributed together, this surprise element of higher 40 bips. Now, housing is also one-off. It's because of the 7th Pay Commission and also the states implementing it. It's not going to be a year-on-year phenomenon. So my own sense is, let's wait. Definitely the March inflation trajectory of the Reserve Bank, we are going to overshoot. Until now, Reserve Bank's numbers were always higher than what actually came about. But this year, the Reserve Bank numbers are going to be lower than the actual inflation. They've given a forecast of 4.7% by March 2018. It is more likely going to be 5, going by this trajectory. But that's not a screaming murder kind of number. And as the base, we are going through a bad base because these are demonetization months 1 year ago. So you will see an exaggerated inflation number. I think if you look at 1 year down the line, things may not be that bad. So I don't think anybody in the market is going to look at a rate hike now. Clearly, rate cut expectations are completely wiped out. But I thought they were wiped out earlier itself. With today's numbers, there may be a minor here or there, someone who may be worrying that is there a rate hike in 2018 itself. But my sense is it's a little too early. That's why I just expect a knee-jerk reaction on the bond yields. And then I guess they will quieten back to the 7.20 level. That's largely priced in. IIP numbers are bad. But I mean, IIP is such a lousy indicator of growth. It needs a lot more revamp as an index. So I won't worry much about that. Let's wait for the third quarter numbers. They will be due in a month. And then we will have a better handle on what growth is. IIP is low directionally. That's an unfortunate number. We should be unhappy about it. But I don't think the markets will react about it.
Okay, well, let's tell you what wise experts have to say about these key macro numbers that came through last evening. Frederick Newman of HSBC says the growth inflation mix continues to remain worrying and isn't encouraging for the central bank to move rates on either side. The possibility that the RBI could cut rates has substantially receded, with greater upside risks looming over the inflation trajectory for the remainder of FY18.
Okay, so that's the impact on markets. Let's get you some money market views. Pramit Brahmabat of Veracity says, strength in crude prices and a strong dollar ahead of the Fed policy outcome will put pressure on the rupee. Expects the trading range for the day to be 64.20, 64.80. Even when there's pressure, it's only 64.20. So we will be glad to take that pressure. On bonds, Dhaval Dalal of Edelweiss AMC says a higher than expected increase in November CPI may weigh on already fragile sentiment in the bond market. 10-year bond yields touched a peak of 7.22 yesterday, a level last seen on July 16, 2016. Price action also looks weak from a technical perspective. He expects the 10-year bond yields to trend towards 7.39 in the near term in the absence of buying support. That said, they expect value buying to emerge at those levels. Oh, I think this is 3.9 is taking it too far. Yesterday we saw value buying come at 7.22. Today it might go to 7.25. I'm not in the 7.39 camp. And yesterday when I called a couple of guys, they were not in the 7.39 camp.
Okay, 7.25 itself has been, quite a move, of course, over the last 2 months. But here's Ronit with the worldview.
Thanks, Anuj, for that. So another record high for the Dow Jones as well as the S&P. A slight underperformance there in the Nasdaq. So now the Dow Jones has hit another record high for the 85th or 86th time this year. So one of the reasons for this record high was on the tax bill optimism. So reports suggest that the lawmakers may have a tentative tax bill which they may announce today or tomorrow. So that's one of the reasons why the domestic stocks were up. Moving on, the second day of the Fed meet begins today. The Fed is likely going to raise their interest rates according to the Fed Watch tool. Around 87% anticipate a rate hike. So on the back of this, we go to the European markets. The European markets also right in the green, dark green coming in from there. One of the reasons was they anticipate a Fed hike coming in from the US markets. Moving on, digital security firm Gemalto, that was one of the stock which was up 34%. Remember, they were the largest chip makers of a mobile phone as well as a credit card. As French firm, Atos decided to buy them. Moving on, to Asian markets. The Asian markets also opened quite mixed, where the Shanghai slight underperformance coming there, as well as the NJ Nifty slight tepid start for them.
Okay. Thank you very much for that, Ronit. I mean, I think this year, the number of working days for the US markets would have been, say, 250 days. I mean, if you take off Saturdays, Sundays and holidays. And of that, 86 days, if it has touched a new high, it has touched a new high every third day, actually. Okay, well, on that positive note, let's look forward to the outcome of the Fed's policy meet. That we will know tonight, and our markets will react tomorrow morning. Jeffrey Dennis, Head Global Emerging Market Strategy at UBS, joins us on the phone line. Jeff, good evening to you. Thank you very much for staying up for us. You know, with the Fed Fund futures telling us that 100% there is a rate hike, that's priced in. What is not, you think? Is there anything tonight, today evening for us and tomorrow evening for you, is there anything that can rattle markets?
Oh, I think so. I think the most important thing is that you've seen significant progress on the tax reform package through the Congress since the Fed last met, and also since the Fed last updated its forecasts. And so our view is that they will come out tomorrow, obviously with the rate hike, that's almost guaranteed. They're going to almost certainly raise their growth forecasts at the margin for 2018 and probably move the dot plot from 3 rate hikes to 4 rate hikes next year. And now we don't think they're going to raise rates 4 times. Our call is still only 2 times, but only twice. But I think there's going to be more attention paid tomorrow on their economic forecasts, what the judgment of the Fed is in relation to the fiscal, the tax reform package, which of course is not going to be fiscally neutral. It will boost the budget deficit. So I think that how the Fed could react next year to the passage of tax reform is going to be the key, I think.
Okay, that's interesting, Jeff, that the dot plot could indicate 4 rate hikes rather than 3. But how will the market take that? Because the Fed has repeatedly warned in the past that they will raise rates at a faster clip if the financial conditions did not tighten as desired.
I think the risk to the markets is if you get the potential for up to 4 rate hikes next year, and at the same time inflation starts to pick up. Now, we're still pretty cautious about what inflation is going to do. In fact, we don't really expect the Fed to change their inflation forecast for 2018. So we've argued for a long time that what's happening here is the yield curve is gradually flattening as the Fed is moving slowly and very predictably. As your listeners know very well, the bond market in the U.S. has been extraordinarily well behaved. And we think even if the Fed does raise rates more than anticipated next year, the chances are it'll just flatten the yield curve more. And I believe emerging market equities are keying off the long end of the curve, not the short end of the curve. And so, another rate hike from the Fed may not happen anyway. I don't think it's going to have a major negative impact on equity markets worldwide.
Okay. Jeffrey, good morning. Last time when you were in India, chatting about how crude oil was perhaps the biggest risk for a market like India. We've seen a move back to 65. Is there a possibility of this move sort of derailing the Indian market rally?
Obviously, the possibility. We doubt it because we're still seeing the dollar in a little bit of a trading range. Of course, I was in India about a month ago, and the dollar internationally is pretty stable compared to where it was a month ago. Of course, it's rallied from its low in September when it was around 121 against the euro. It's about 117, 118 now. So the dollar's stuck in a little bit of a trading range. So the risk is, of course, the dollar goes firmer. That would put the rupee, indeed, pretty much every emerging market currency under pressure. But one of the things we think is really interesting, and we published a report about this some 24 hours ago, is that although there is this increased talk of tax reform in the U.S., and although it's led to a sell-off, or led to a sell-off in EM up until a few days ago, in particular in the technology shares in Asia, the bond market didn't move, and the dollar didn't move much. And I think while the dollar continues to be broadly stable, and we expect it to fall again next year, I don't see this putting the rupee under tremendous pressure. And so, no, we don't think the rupee is something that's going to bring the Indian market down anytime soon.
Okay. Well, just a final question. I mean, you almost answered it. If indeed tomorrow there is this, dot plot indicating 4 rate hikes instead of 3, should we expect some knee-jerk reaction on the emerging markets? Or will they take heart from the fact that this is coming on the back of higher growth in the mother economy?
Well, certainly that is going to be a useful offset without any question. I think what will impact emerging markets is not necessarily the possibility of another rate hike next year. Although the market is not pricing anything like 4 rate hikes, as you know, I think what's going to matter for emerging markets is what does the tax reform package look like? Is it going to lead to major upgrades to GDP forecasts? We've not moved our forecast yet because we want to see what the details of the tax reform package will be. I think a bigger risk would be a very expansionary fiscal move by the U.S., which pushes growth higher. That sucks money back towards the U.S. out of emerging markets. I think that's a greater risk than anything that follows a shift in the dot plot tomorrow. People are very focused now on what U.S. growth will be next year, and probably the big driver of that in the short term is going to be what this tax package looks like, and indeed whether it even passes at all.
Okay. Well, thanks a lot, Jeff Dennis, for putting that into perspective. Thank you very much indeed for joining us. Well, we must expect that the rate hikes will come only on the back of, solid growth, unless the Fed is extremely upset with the deficit that will come because of the tax reform. So, yes, I think that statement is going to be passed very carefully.
Yeah, and as Jeff was telling us, more than the FOMC statement, the details on the tax reform and what comes through is something that the street is watching for very closely.